Fantastic. It looks like sound is fine. I'm hoping that you can see my disclosures right now. And I just wanted to remind you, just spend 30 seconds just looking at that, and then we'll begin with our webinar. Okay, guys, great. So just in terms of our disclosures, this webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management techniques, concepts, strategies, and does not include recommendation or endorsement of any particular security, chart pattern, or investment strategy by forex.com. This webinar has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. It will include references to actual past trading results for discussion purposes only. Futures, options on futures, foreign exchange, and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under Commodities Exchange Act. And just to remind you guys, contracts for difference or CFDs, they are not available for US residents. Okay, everybody, Happy New Year to you all. Thank you so much for joining. It's great to see so many of you here as well, because I know we changed the time of this webinar. I'm hoping that the change time, let me just swap a few things around right now on my desktop. I'm hoping that the time will work much better for you all. This is, I think, just before lunchtime. It's quite a nice time just to, have your thoughts about you, and then obviously we've got time to digest the Eurozone data, and also got time to think about maybe what's coming out in the US. So we can really use this as a nice segue or midway point, if you like, through the market. So the chart that you're looking at right now is the daily. It's the dollar yen. I just sent out a piece, actually. In fact, we'll give you the link because some of you may find it useful. About the dollar yen, because dollar yen, obviously this time kind of a week ago, or this time a week ago, it was looking all good, great, fantastic, wow, it's got above 105, isn't this great? We're going to be at 110 before you know it. And as usual with dollar yen, it promises so much and then just doesn't deliver the goods. So what we've seen is quite a sharp pullback, and you can see that that's very, very clear on the chart. But it is interesting. I did want to show you the daily RSI as well, which comes in here. That had got above 70, so it was looking very overbought really in that period between Christmas and New Year, when what we saw was quite a sharp run up in dollar yen. So instead what we've got is just a pullback here. As you can see, it did test the air below the 21-day moving average, which came in roughly about 104. Got as low as 103.91 actually yesterday, which I'm sure sent some of the dollar yen bulls into maybe light heart palpitations. I don't think really this is going to be a particularly for the longs out there. I think they're going to really not get comfortable in January until we get back above 105. Then of course that 105.75 level is kicking in, and I just want to show you something about that level. Oh, actually I want to show you two other things first off. The first is this, some people have been saying, well, what is it that's, really weighing on dollar yen? This is dollar yen in the Nikkei. It's something that I included in that report, the link I just sent you, and as you can see here, the blue line dollar yen, the red line is the Nikkei, and really this just goes back to October, the beginning of October. But if you go back really for the whole year of the whole of 2013, it's got a very, very close relationship. So right now the Nikkei is looking not very perky. It's looking a bit poorly, actually, the Nikkei, along with other Asian stock markets. It's a mix, really. There's concerns about liquidity issues. There's concerns about, so we've got the liquidity issues. There's also concerns around the whole, there's also concerns around China slowing down, around, some really bad news on some bad news around the emerging markets face political issues. Obviously we've got Turkey. I'll talk about Turkey more in a minute. But that's really weighing on the Nikkei. And that to us is one of the reasons why dollar yen can't move higher. purely technical, it makes absolute sense, right? That, one would think that the Nikkei, that the dollar yen would move the Nikkei, but it's very hard to tell what drives what. Because, certainly in the past, dropping the Nikkei has led to a lower dollar yen. And that's what we saw yesterday. And that weakness has carried on today. But it's how deep that weakness is that could really kind of trigger, concern for FX investors. But it's worth, as we always say, markets don't move in isolation. It's worth looking at what's going on elsewhere. If there's problems in the Nikkei, does that mean that there's risk aversion going on? And then that would naturally be, yen positive. That seems to be what's happening here. So it could actually be the Nikkei driving dollar yen higher, and not necessarily the other way around, because the Nikkei is maybe reflecting kind of broader events. So for now, anyway, you've got to look towards the Nikkei, certainly in the shorter term. There's also something else I'll show you about dollar yen. Let me just drag it down. Hang on, sorry, it's just up here. This is dollar yen and 10-year treasury yields. I don't need to tell you, you guys are pros, you guys know what you're doing, but obviously non-farm payrolls on Friday. In fact, it's a big day this week, actually. So in a bit of a slow start, there's been some thin liquidity around, but we do have Fed minutes tomorrow. I don't expect them to be to tell us too much of anything new, but I do think that obviously the non-farm payroll is going to be key. In between them, we get an ECB and a Bank of England meeting. In my view, I think that the non-farm payrolls is the key driver. I don't think we're going to get anything new from the ECB or the Bank of England. I just don't see what would drive it, especially the Bank of England. They've got an inflation report next month. Typically, the month before an inflation report, you may as well, nothing happens. They purposely keep things quite calm and steady. Likewise with the ECB, I think it's just going to be like, there's more, positive tone to the markets, etc., or positive tone to the recovery, etc., etc. Spain doing very, very well. But we've got to keep vigilance, and we're aware of X, Y, Z. But so that's why I think that non-farm payrolls really is the variable that could change the pace of tapering. Obviously, if we get a weak report, that could weigh quite heavily on the dollar yen, because it seems unlikely that the Federal Reserve would actually be able to push higher. Certainly push on with aggressive tapering if the labour market is dipping, as we got kind of end of 2013, beginning of 2014. The other thing, obviously, it's all, when it comes to, labour market report that has such a big impact on Fed decisions and policy and monetary policy, that what we tend to see is, it has a big impact on treasury yields. So here you can see this is the yellow treasury yields, the white line is dollar yen, very close relationship. I'm not saying they move lockstep all the time. What I am saying is that they tend to move in the same direction, and you don't often get certainly not for very long periods whereby they kind of move in opposite directions. Obviously we did around this period here in around April, and that was largely because of impacts with Japan, so with unusually large monetary stimulus in the second quarter of last year from Japan. So that's certainly worth watching there. But as you can see, that 3% level in is really important. We were above it at one point last week, but we've since kind of moderated, come back from there. For us to see it get above some key levels like the 105.35 level, that's key Fibonacci resistance level right now, from 2007 to 2011. I'll show you on that. 105.75 is the level you need to etch in your brains. For us to get above there, we think that we need to see treasury yields comfortably above 3%. I'm not saying they have to rush above 3%, but to get, the 106, maybe 107 levels in dollar yen, we think we need to see treasury yields break above 3% and stay above 3%, obviously, because of this close relationship here. And again, we've had false starts before. Treasury yields have kind of gone above 3% and pulled back, etc., etc. So we really are watching it quite closely now. Alan, you've just asked me what is my expectation for NFP. Well, I'm not say that yet because we haven't put our model together, because we don't have all of the of the moving parts for it. Ours will be put out. There'll be a webinar on Thursday at 7 London time, 2 p.m. US time. But I can tell you now that the market is expecting around about that mark, about 195, and I would concur this month. I think there is even though we've seen some weakness in the data, the non-manufacturing is in yesterday, the manufacturing is in at the end of last week. I do think that the outlook is actually, if you look at the components in those surveys, the employment component has held up quite well, and that should be quite good news for payroll. So I think your expectation of around 200 and 210, you're very in line with market consensus there, Alan. So obviously, when market consensus is for, say, 200-ish K, or say 195 to 205, that seems to be the consensus. Obviously, if we get anything 210 and above, that's going to be considered very positive. That could be dollar positive. That could push the dollar yen higher. Likewise, on the downside as well, if we were to get something 170 or below, I think that would be a big disappointment for the market, because they've got used to good economic data. Added to that, the unemployment rate of 7%. Certainly worth watching there, because if we were to get a drop in the unemployment rate to 6.9, all of a sudden we're in some sort of new paradigm, and I think that could have quite a large impact on the market as well. So certainly worth watching out for there. So let me just pull up my other chart. Hang on. Oh, just see those levels that I was talking about. See how far this one goes back to. No, I'm going to have to do it. So there you go. It's not completely right. But it's around about 105, 30 to 60 to 50 level. That key Fibonacci level that a lot of people are talking about, that is really acting as a bit of stickiness now. That also coincides, I'll show you here as well, with the 200-month moving average. Sorry, bear with me, guys. As you can see here. So just a really overall kind of very, that doesn't, if we get above that Fibonacci level, and that opens the way to the 200 month moving average there, as you can see, that's the level of resistance at 107.30. But this kind of 105 kind of 30 to 50-ish area is very, very sticky. The one thing, obviously, from a monthly perspective, we are also looking to be overbought here. Now, I know not many people would ever look at a monthly RSI, and I don't blame you. But when it's kind of been reflected in the daily as well, you've got to say this is just a pullback. I believe it is a pullback. I mean, it still looks like quite like a nice trend there. Let's just draw a couple of lines on here. I really think that the market would probably be willing to give that a little bit more, actually. We'd have to get down, if we were to get down to, I think if we were to break below 103.70, so, convincingly get below this 21-day moving average, then we could see a bit of a deeper decline back to that 103 level, just based on a very simple kind of trend line. I don't think it's, the uptrend is still in place, and I think we're really seeing that. The minute we got below 104, there was a lot of buying interest that came into the market overnight, so definitely worth watching out for there. But for us, if you are bullish on non-farm payrolls, if you're looking for a strong number, continued US good economic news, particularly on the labour market front, then I think, which essentially some people in the market are, a lot of people in the market are, the market consensus for a very healthy payroll support, then really the market is going to fade any weakness in dollar yen. Certainly in the lead up to there. But until then, until we get an non-farm payrolls report, as you'll see in my note, we could potentially oscillate really, trading quite a choppy range, because that labour market report is going to be quite important. Because now we know that the Fed is willing to taper, next month the jigsaw puzzle, like we all have to act like detectives almost, is trying to figure out why it's trying to figure out, what the pace of it will be, how big will it be, how long will it take, and economic data is going to be crucial to those decisions that the Fed makes. I'm going to look at Euro-dollar next. I know, Vicky, you want to look at Euro-dollar, and Alan, I'll look at Kiwi-dollar in a moment. But I think Euro it's had let's say an interesting couple of days. I'll take this off. Bear with me. So this is the daily chart. What a pullback, huh? But managing to stay above that 100-day. I'll also bring down my other chart, sorry, just for a moment, because I want to show you some of this. Just a daily Ichimoku in euro dollar. As you can see, we did, dip below, we kind of tested below that 136 level, got down to kind of that 135.70, but always stayed above that 135.75 level, which comes in here, that green line on the chart. It's the top of the daily Ichimoku cloud. The daily cloud is really narrowed, suggesting that we're in consolidation mode, and I really believe we are. I don't think there's any key drivers for euro dollar. We've got quite thin liquidity. Obviously, the ECB meeting is going to be absolutely crucial. I think it's going to be quite important. I think the markets are a little bit hesitant to go too short euro dollar. Now, as I said at the beginning, what we've seen since the start of 2014 is currencies that have done very well throughout 2013 were being sold off. So it really looks like a positioning move, and that included euro dollar. For those of you who followed our research last week, you'll know that we put out a piece that just measured performance, annual performance in the G10 versus the US dollar, and the euro was the strongest. Not by much, it's up about 4%. And obviously things like the pound had a fantastic run in the second half of this year, a really good rebound. But overall, from January to December, in 2013, the euro was the strongest performer against the US dollar in the G10. So, nothing goes up in a straight line. A pullback is necessary. Obviously now there are some fundamental issues, but right now, as long as the Fed is still expanding its balance sheet and the ECB doesn't look like it is, we could potentially still see, we think the downside for euro will be limited. As you can see, we're staying above this cloud, so the technical uptrend is still technically in place. But obviously that was quite a sharp shock. So to us, it still feels like positioning. And the medium-term direction is going to be delivered, is going to be, very much determined by what happens at this Draghi meeting or the Draghi press conference on Thursday. It starts at 1:30 our time. The key thing to point out, of course, is that if he turns around and sounds quite upbeat, that they still think there's positive data out there, they don't seem too worried about deflation, then what we may see is a rebound, potentially back to this level here, kind of the 136 level, maybe even up to the 137.40, which is a Tankan line on the daily cloud. However, if they sound very worried about deflation, and remember, we did get a drop in inflation. The December inflation estimate was released for the Eurozone at 10 o'clock this morning, and that came in at 0.8% from 0.9%. We are edging ever slowly closer to that deflation territory, and that could see us fall through the bottom of that cloud, which comes in at 136.55. If we get below that, I think we could easily see to the 134, maybe even down to this kind of 133 level, which are the lows from November. So definitely worth kind of watching there. Now, what about the pound, Rose? Rose is asking about the pound. Let's take a quick look at that. And sterling has come off quite sharply. I mean, the uptrend is still in place. Added to that, I just want to show you, is the 200-month moving average for the pound that is the key level. This 166.35. I could probably tell you, I don't know how many times I could tell you how many journalists have rung up and asked, what is going on with cable? Is 166 the long-term top? The one thing I'd say for cable this year is that it's almost been a victim of its own success. On the one hand, we have, it's going to be really hard to get those outsized economic data surprises like we got in 2013. On the second hand, we do know from the minutes of the December Bank of England meeting that the bank was sounding a little bit concerned about the strength of sterling, and that could lead to a very uneven recovery. And then from a technical perspective, we have this 166.35 level, which the market is respecting. A lot of people are talking about it. It coincides with a few other technical indicators as well. So this really is a level to watch. It's a level that has triggered some profit taking. Added to that, it's got the same problem as the euro. It's a good performer the second half of 2013, and as we've seen, it's those good performers have actually come in for a bit of a torrid time of it right now. So where might we go next? Well, to look at that, you've got to look at kind of a much shorter term chart. So as you can see, managing to cling above that 164 level. We had got down to kind of sub 163.50 at one point yesterday, or certainly overnight. Let me just change this chart. Sorry, guys. Certainly overnight in the Asia session on Monday. But we have kind of climbed back. Obviously, it looks fairly lackluster. There's a cluster of support here at 164.50, and that seems to be attracting some selling interest. So I still think that this week we don't expect anything from the Bank of England, because, as I said, there is an inflation report in February. That tends to be when the Bank of England make their changes. Instead, what we think could potentially happen is that we get a little bit of, again, that choppy range trading, and then actually the medium term direction of the cable will certainly for into the next few days of next week will actually be determined by the non-farm payroll report. And a strong number could weigh on cable, could push us down to that 163.50 level, and even back below there. Let me just pull up the other chart one moment, back to that 50-day moving average. Oh, sorry, guys, you get to see my very clogged desktop instead. Moving average, which comes in at 162.63. Until then, we're still trading the uptrend is still in place. Just draw that there for you. As you can see, we have got a bit to play around with. That 62 kind of 50 to 70 level. You could essentially fall back to there and still climb higher. Aren't these big green candles high potential market? Miriam, aren't those big green candles high potential market? So I think what you mean there is potential for the market to go higher. I would argue that you've got, yes, some big green candles, but you also have, this is the daily chart, remember, you also have some quite big red ones to the downside. So yes, as I said, this twice as a pullback, so the market could go higher. We do think that 50-day moving average around about that 162 level, 162.65 to 70 level, could potentially hold as support. There'd be nothing in the data at the moment to suggest that the pound should be weaker. But as I said, it might not be the pound's doing. It might be, cable could fall, but if cable was to fall lower, we think it could be because of the spike higher in the dollar. And we're just not sure that's like we're up there yet. I also want to show you the candlestick chart here for cable. Sorry, the daily Ichimoku cloud chart, And as you can see, we're far away from the base of the cloud, so we're still moving higher. However, when the cloud narrows, it does suggest that we're just moving sideways, and that would be very normal around ahead of some big levels, particularly ahead of some big critical fundamental data coming out of the market. Now, to balance all of this, going to look at Kiwi in a moment, Alan. Just bear with me. I'm going to stick with the Aussie for a minute. As you can see, a bit of a nice rebound, but nothing massive. So as I said, the moves that we've seen in the market in the G10 area anyway could just be a little bit short term in nature and just positioning really. So we saw kind of the beginning of the year the Aussie do quite well, but again it's just stumbled at that 90 level. It just can't get above it. Still looks very, very weak to me. Now let's take a quick look at Kiwi. Kiwi here, as you can see, a big congestion zone. It's not really one way or the other. Kiwi had massively outperformed Aussie last year. Aussie, along with yen, were the weakest performers in the G10 last year against the US dollar. As you can see here, I think with Kiwi, you've just got to look at your levels. There aren't any major drivers. We're all waiting with bated breath to see whether or not the RBNZ will have the guts to hike rates. Remember, the first in the developed world to hike rates when they meet later this year because of basically rampant house price inflation, really. But on the downside, 82.40 holding very nicely as support there. It really is just kind of cupping the downside, the pink line on this chart. And then we are approaching a key technical level of resistance, certainly in the short term anyway. This kind of 83.40 level, so we're currently at 82.85. If we are to continue moving higher, and then we might get up to that kind of level, which would be ahead of that 84 level, which would be critical. I just don't see any major driver. I think it's because it's being driven by other things. I prefer to trade other things like dollar yen, maybe a bit of euro dollar as well. I'm not really seeing Kiwi's not being driven by New Zealand factors or domestic factors. New Zealand dollars will be driven by, positioning in the market, for example. Maybe some risk aversion. If we get big bouts of risk aversion, that could be very negative for Kiwi, for Aussie, etc. Maybe also for waiting for, it will depend. It will do whatever the dollar does, essentially. Miriam, what are you talking about there, Miriam? Are you talking about Kiwi? Or are you talking about? I'm assuming you may be talking about Kiwi. And it looks like you kind of watch. Kiwi dollar. That sounds good. So you obviously watch. You seem to look at Elliott waves. That's a massive move, and I think we'd need to see a big wave of risk aversion for that. As you can see right now, they're really the cluster of support on the downside. So if we were to fall, we'd have to negotiate that kind of 82.40 level first, the 50-day, then the 82.1, and then 81.60 is a massive level. But yeah, if we get below there, we could fall quite sharply. So if you're looking at New Zealand dollar and you're looking to get back to those lows from kind of August, we'll have to, you'll have to kind of, there'll have to be a driver, and I don't see that driver at the minute, and I don't see that happening at the minute. That definitely doesn't mean it won't. Remember, we were there at the end of August. You just need to be a bit vigilant. Just be patient. Obviously, certainly in the short term. Sorry, Miriam, I hear you are from Italy. I'm sorry if I talk fast. But as you see here, I mean, that's, fairly bullish there that we managed to break above that 82.50 level. We kind of broke that kind of downtrend. So that suggests that maybe in the medium term, we could potentially push a little bit higher. But do follow my colleague Chris Tedder on our website, forex.com. He is the New Zealand, Asia, Australasia expert. So I also want to show you gold as well. Gold has been interesting. Gold is in recovery mode, and you really like gold. Gold is still in recovery mode, still testing around about that 1340 level. Hasn't really been able to get above there. 1240 level. 1249, the 50-day moving average, is your next massive level of resistance there. Do I really feel a great interest in gold? Not really. I still think it's quite negative. I still think it could go weaker, but I think it's benefiting certainly from some weaker economic data out of the US. If we get a strong payrolls number, I think that any move back towards 1250, maybe even above 1250, towards kind of 1260, 1270, which would be the highs from kind of early December, could be used to sell into, maybe sold into actually. Oil as well. Are you looking at Brent, Pan? I'll pull up Brent quickly anyway. With Brent, it's trading very much in a range. Interestingly enough, though, it's just hovering around about that 200-day moving average at 107.46. That's the key level. We had a close below there yesterday, and if we get kind of a close below there, another close below there, that would be quite negative, which could essentially open the way to these lows from the first week of November, which come in around about kind of 103.50ish, just below 105. Both seem at low levels. I know what you mean. They do. There isn't too much, in terms of open interest. There hasn't been too much or in terms of volume in oil. It's a little bit trading volume. It's just a little bit weak. This is fairly thin liquidity. I think the markets are seeing it as, obviously any weakness in economic data that's weighing on it. Likewise, we've seen, this pullback here could have been triggered by some risk aversion. Remember, we've had some quite weak PMI data globally, actually. Well, weaker than expected. Obviously, there was the US, there was Germany, there was the UK, and there was also China. Now, China has some very, very weak data, and whenever that happens, all of a sudden the oil market kind of takes a bit of a dip. Both do seem at low levels, but I think that we're going to have to, it may depend. I mean, we're kind of in a rock and a hard place with oil at the moment from a fundamental perspective, right? Because essentially if you have, if you get good, strong US economic data, that's great. We'll push higher. But no, we won't, because that could potentially mean that the Fed is going to taper really fast, and then we're going to be into tightening territory. My argument with oil is a bit like, is that it's going nowhere fast. It's range bound. It has been for the last kind of 2 months, and I don't really see us getting anywhere. I think that, if we were to fall back, if we get, decisively break below this 107.50-ish level here, this 200-day moving average, then it opens the way to 105. And then obviously on the upside, there's a cluster of resistance here, which comes in at 109.14 and then just below 110. That to me is, when we are below the moving averages, obviously the sentiment is to the downside. We've had some big moves within this range. And, you've got to look at kind of the fundamental data. Look at when follow us on our website. One of my colleagues here often tweets about inventory data. All of that type of impact is going to have a big impact. The other thing to watch as well when it comes to oil and stocks, obviously, is that we kick off earnings season. Stocks haven't really moved anywhere. Oil is still, even though it's had some big moves, is still essentially in a range. What we're looking for, I think the reason why is because we're looking for earnings season to see what people, did they perform well? Are their outlook good for 2014? And once we get that, then we'll have a bit more direction. I'm not seeing any direction. And that's really the same for WTI as well. As you can see, WTI is quite weak. It's fallen below that 50-day moving average at the end of last week, which came in at just below 96. And obviously the next level of support here becomes this kind of 91.90 low from the 27th from the end of November. So really worth kind of holding on there. Obviously sentiment to the downside, but unless we get some, maybe, really continued dreadful economic data. If we are to get, if this is going to turn into a bout of risk aversion, then what we could see is a drop below that kind of 92 level, which would open the way to 90, which is obviously a very key psychological level as well for this. So some good points there. Now, guys, I believe I've run over my time just about, but I'm happy to take another couple of questions. Month at 90 soon. I think you need to, will it get to 90 soon? 90 is a key psychological level. As I said, sentiment is to the downside. I can't give advice, but we could see, some further downside definitely. As I said, that 90 to 92 zone will be, critical actually from the support perspective. Okay, the last thing I look at, Sterling Aussie. Sterling Aussie has come off a bit, but as you can see, still very much in that trend. And I wouldn't be surprised if we go back to trade those highs at 186.98, just below 187, which we saw on the 2nd of January. I think that we will rebound. We are already today. And that pullback was necessary. It was really positioning, people taking profit. And then, if we can get above that 180, just 187 level, that opens the way to 190. Okay, everybody. Thanks for joining. Ray, thank you for your nice comments. Please do join us next week. The 11 o'clock start is going to be a permanent thing. And thank you all for joining. It's been good to get back into the new year. Okay, everyone. Thank you.